Ladies and gentlemen, up next is a thought provoking session crafted to navigate the evolving landscape where technology, taxation, and transformation converge. As we move deeper into the digital age, social media has evolved from a space for personal expression into a dynamic platform for income generation. Influencers, content creators, gamers, and digital marketers are now part of the fast growing digital economy, one that often operates beyond conventional tax frameworks, creating complex challenges for tax authorities across the globe. How do we identify and regulate the digital income streams? Can the proposed direct tax bill provide the structure needed for the new age earnings? These are no longer future possibilities. They are real world challenges demanding immediate attention. Dear attendees, welcome to the Knowledge Session 3 on the topic Direct Tax Bill and Social Media. This session is designed to demystify the taxation of digital income and offer clarity on emerging tax frameworks. Guiding us through this session is our esteemed chairperson, CA Malavika Kamath, an accomplished tax professional and thought leader. Joining her are our dynamic paper presenters, each bringing unique perspectives on the intersection of digital content and direct taxation. I now request CA Gaurav Hegde to escort the chairperson of the session to the dais along with the paper presenters. I kindly request sir to hand over a sapling to the chairperson and the paper presenters to mark the special occasion. Thank you, sir. Before I hand over the session to our presenters, I take this opportunity to introduce CA Malavika Kamath, a seasoned tax professional currently serving as a partner at Ganesh and Sudhir Chartered Accountants, where she leads the firm's direct tax litigation, compliance, and audit practice. A BCom graduate from MAPS College, Mangaluru, she pursued her articleship at Ganesh and Sudhir Chartered Accountants. After qualifying as a chartered accountant in 2015, she joined Deloitte Bengaluru in the global business taxation team. Over her 4-year tenure at Deloitte, she gained in-depth experience in corporate taxation, international tax advisory, litigation, and compliance. In 2019, she returned to Ganesh and Sudhir Chartered Accountants to join her father CA Giridhar Kamath and other partners in further strengthening the firm's tax and audit verticals. She holds a post-qualification diploma in international taxation from ICAI and is also a registered valuer for securities and financial assets. Beyond her professional accomplishments, Ma'am is an avid reader of both English and Kannada literature and a passionate trekker, having completed several expeditions across the Himalayas. She and her husband CA Vikas Shanai are proud parents to their daughter Kashi. It's our pleasure to have you with us, ma'am. On behalf of Mangaluru branch of Sikasa of ICI, I accord a hearty welcome to you. I'm delighted to introduce our insightful paper presenters who will be taking us through the key issues shaping the direct tax treatment of digital content. Our first presenter, Ms. Preemal Dsouza, will present a compelling paper titled, "Will the new direct tax bill bring clarity or confusion to the digital income ecosystem?" Preemal Dsouza is a CA final student undergoing her articleship at Shetty & Co. Mangaluru. She holds an MBA in finance and has showcased her musical talent as a semi-finalist in TV singing competitions such as Daiji World Studio Voice and Muzo Talo Gaitalo. In her free time, Preemal enjoys playing the guitar and writing songs, blending her passion for music with professional journey. Let's extend a warm welcome to Ms. Preemal Dsouza as she shares the findings with us. Over to you, Preemal.
So every financial year, various stakeholders are eagerly and impatiently waiting as to what new laws the finance bill is going to put forth and how it is going to affect their livelihood. Well, surprise, surprise. This time it was the direct tax bill of 2025. So be it CAs, tax practitioners, and our oh so amazing CA student fraternity, all of us were left in wonder, question, and confusion as to what new things do we have to keep up with. Well, all those mixed feelings aside, I, Preemal Dsouza, take pleasure in extending a warm welcome to our session moderator, CA Malavika Kamath, our expert guide for this session, and my co-presenters, an all-star lineup, and especially each and every one of you brilliant minds and creative souls here this morning. So, the direct tax bill of 2025 is poised to effect significant impact, especially to the digital income ecosystem. How is it going to happen? And what are the changes, you ask? Let's find out. So for the next 10 minutes, we'll be looking at 5 things. One is we'll be gaining an insight and understanding as to what exactly is digital income. Next, we'll be looking at the key provisions which are going to govern this digital income taxation. Further on, we are going to discuss on how the direct tax bill is going to impact different segment earners. Finally, we'll be answering the most crucial question. So, can we say there is confusion or clarity? Next, we are going to conclude with taking key takeaways as to what could be anticipated or expected from the direct tax bill of 2025. So, what is digital income? To understand it in a layman's sense, digital income refers to any income that has been earned or generated through online activities or engaging in any online services. It could also include investing digital assets. So this could also mean a varied and vast ecosystem that could be affiliate marketing, it could be selling digital products and services, it could be freelancing by way of content writing or ad or marketing or whatever, or even insisting or investing in virtual digital asset. So what are the key provisions? The direct tax bill of 2025 doesn't actually define the term digital income. However, there are provisions which are governing this very digital income ecosystem. First, let's look at virtual digital assets. So, what is virtual digital asset? In the existing provision, virtual digital asset refers to any information, code, number, or any token, not being an Indian currency or foreign currency. You've seen those serial numbers on the note, right? Well, apart from that, these virtual digital assets, they are said to carry a virtual representation, a digital representation that it carries an inherent value and it can be used in financial transactions as well. Remember, it is also capable of being stored, transferred and traded virtually and electronically. It is also inclusive of a non-fungible token that the central government has notified to be included as a virtual digital asset. So what did the direct tax bill of 2025 do, you ask? Well, there's a new clause that has been included, a crypto asset. So the crypto asset is nothing but a digital representation that it has been stored cryptographically in a secure distribution ledger or any other such similar technology. Now, this very definition, this very meaning could also be inclusive in the existing clauses. Anyways, the central government has also specified that it also retains the power to specify any such other digital asset which is to be excluded from the definition of virtual digital asset. Now, you might be thinking, okay, enough about this virtual digital asset. What about the other digital incomes? Well, as I said earlier, the definition of digital income is not really specified. However, basic provisions would apply. What are they? If any income has been received or deemed to be received in India, will be taxable. If any income that has accrued or arising in India also will be taxable. So it also includes any sale or transfer, or the definition of transfer will apply as to virtual digital asset. Further on, we'll be looking at what are the different tax rates applicable. Now, as I mentioned that the deemed to be received or accruing or arising provisions would apply. But in addition to that, let us look at what are the tax rates applicable with respect to capital gains, with respect to profits and gains from business or profession, as well as income from other sources. So, this direct tax bill of 2025 has introduced and included gig workers. Now, you might be wondering, who are these gig workers? Gig workers are no one but our beloved delivery partners of Swiggy and Zomato, or any other service partners with Uber or companies like Urban Company. Now, remember, these people are not really employees of the said companies, but they're under a contract. So, the tedious provisions which affect contracts will apply to these gig workers. That is, if the payments made to them by the company during a financial year exceeds 50,000, it will be liable to tedious implications. Then we also have sale of goods and services through an electronic commerce operator, as well as any transfer of virtual digital asset. Now, when we speak about tedious provisions, this means that income data sharing is going to continuously take place with the CBDT. Enough about that now. Let's look at what impact the said bill is going to bring on different segment of earners. First of all, in the case of freelancers. Now, freelancers, if they are taking it as a whole time thing, obviously it will be classified as profits and gains from business or profession. Or in any other case, if it's sort of a side hustle, they may show it as income from other sources. However, it is pertinent to understand that these very freelancers, they seek fewer tax compliances, and also they want fewer hassles with respecting to filing their returns, and also retention of deductions that could be applicable to them. But this would also mean the government has to implement stricter digital income tracking. Now, coming to content creators. I won't dwell too much about it because my co-presenter Hani is going to take you in depth about it. But otherwise, it will be shown as profits and gains from business or profession, or income from other sources. There is no tedious provisions applicable on the same as of now, but who knows what changes could come by our way. Further, we are going to look at gig workers. As mentioned earlier, they are going to show it as profits and gains from business or profession, as well as tedious provisions will apply from now on. These very gig workers do not want any excess classification with respect to being employees, because they want fewer tedious deductions, or no tedious deductions at that. Remember, even the companies, in order to avoid the very provident fund compliances or any employee state insurance compliances, do not want further employee classification. Companies like Zomato or Swiggy or Urban Company or Uber will seek all of this. Next, let's look at e-commerce sellers. Now, the e-commerce sellers, as mentioned earlier, were always liable to tedious provisions. In addition to that, there is TCS provisions applicable. However, these do seek a more simplification and no overlapping in GST implications as well as direct taxation. Further on, let's look at the crypto traders and also the stock derivative traders. Let's look at them combined. Any sale of crypto asset we know is liable to flat tax at 30%. In addition to that, there's a 1% tax applicable with no loss or expenditure offset, and irrespective of it being a loss-making trade. Now these traders do prefer a more clearer understanding as to why such taxation exists. This could bring about a more positive response to the same. But this would also mean that CBDT will have to track wallets and exchanges more aptly. Now, in the case of remote workers and digital nomads, learning from our exams and what is applicable in our syllabus, we know that for a resident and ordinary resident, income is taxable on a global basis. On a global basis. So, irrespective of where you are, if you're a resident and ordinary resident, you are going to be taxed on your income. But in the case of digital nomads, even if their clients are foreign, if such services are given in India, it is going to be liable for tax implications. Further, let's answer the main question. Can we say that there is clarity or confusion? With respect to reduced litigations, because there will be better digital tracking, uniformity in taxation, and also ease of compliance, we can say that it will bring about clarity. But potential confusions could involve that the government could have to be taking a step forward into better implement these tracking. As well as there could be compliance burdens on the assessees themselves, as well as countering ambiguity in definitions could also pose a threat. So what can we say? The Direct Tax Bill 2025 indeed is a positive step forward, but it would require periodic reviews and amendments to keep up with the latest business trends. Thank you for your time.
Next, Ms. Honey Meswani will unveil her insights from a thought-provoking paper titled, "How can Direct Tax Bill Adapt to the Evolving Nature of Social Media Revenue Streams?" Honey Meswani is an articled assistant at Shetty & Co. Mangaluru. Along with her academic and professional commitments, she is a passionate sports enthusiast who actively participates in badminton and throwball. She has earned several accolades including Sikasa level awards and a national level victory in throwball. Additionally, she has secured second place in the marketing competition at Yuva, a CA Students' Fest organized by the Sikasa committee. She strongly believes in maintaining a balance between academics and extracurricular activities and embraces new challenges both on the field and in the professional arena. Let's welcome Honey with a round of applause. You may take over.
In today's world, a 19-year-old can go viral in a snap, earn millions dancing in bunny slippers, and the income tax department is still trying to make sense of all of this. I mean, let's be real. When income comes through reels, salaries comes through subscriptions, and bonuses comes to paid collaborations. So, should the income tax department still be stuck in a one-size-fits-all mode? Well, hello everyone. Welcome to my session chairperson, my co-paper presenters, and to the lovely audience. I am Honey Meswani, and today I'll be diving deep into how can the Direct Tax Bill 2025 adapt to the evolving nature of the social media revenue streams. Also, the bill can finally ask the question, let's stop treating creators like some factory workers, and also, it can finally ask the question, that is, let's stop ghosting the Gen Zs and finally start going viral for the right reasons. Let us first look at the overview of the Income Tax Bill 2025, starting with something very basic. But this is actually a game changer. That is the concept of tax year. It replaces the confusing previous year assessment year, and the bill proposes a clean tax year starting from April 1st. To be honest, we are going to miss having this conversation in our office that goes like, hey, tell me the GP of 21-22 now, and getting the classic old reply, that is FY21 or AY21, specify now. And then the provisions of section 194 are, if these influencers get freebies or benefits exceeding the value of 20,000 rupees, there would be a TDS of 10% on it. And most important and interesting point is starting April 2026. This income tax department has free access to all the social media platforms So these influencers have to be very careful at it, as it leads to tax evasion on any kind of suspicious transactions. Now that we understand the system's makeover, let us look at the incomes that it is trying to tax. And trust me, it is not as simple as salaries. It is something fluid, fragmented, and frankly speaking, fascinating. Imagine a world where your phone is your office, your personality is your product, and your creativity is your currency. This is exactly what life looks like for influencers today. They earn income in ways we couldn't have even imagined a few years ago. But what is the big problem? The big problem is we do not know how to track this. So let us learn about this with a small example. Meet Disha. She is an influencer stuck in between content and compliance. Her story isn't just unique, but it's a wake-up call. With over 3 lakh Instagram followers, she earned easily around 50,000 to 1 lakh rupees per Instagram post. Brands loved her content. One single brand even paid her rupees 1,30,000 for a single Instagram campaign. Sounds great, right? But here's where the story takes a turn. When the income tax department reviewed her content, they were shocked to see that she had reported only rupees 73 lakh as her income. Now, why did this happen? It was because she was unaware that all the part of freebies and benefits that she gets also forms part of her taxable income. Like her, many other influencers are confused whether to classify themselves as businesswomen, freelancers, or something entirely different. Now, what is this income actually? It does not come from one job or one place. It comes from many places like ads, sponsorships, and so on. But the twist is the current income tax framework does not provide proper framework for these influencers, leaving many in the digital age confused about their tax obligations. So what is the actual goal? The actual goal is to adapt to these new revenue streams so that there would be a proper smooth functioning of the same. Now, let's zoom out. It's not only about the influencers, it's about the entire gig economy. The first suggestion would be applying progressive slab rates so that these growing investors and creators can be less overburdened. And then, let's not forget simplified tax systems so that there is a reduction in the chance of making mistakes. Moving on, the first suggestion after this would be the platform should act as tax allies. There should be proper and detailed breakdown of income, expenses, deductions, and so on. This exactly sounds like Form 16, but a creator version of it. And then most importantly, there should be conduction of targeted audits for high-end influencers and also suspicious platforms. This does not lead to intimidation, but leads to transparency. Most importantly is tax education, which can be achieved through videos, short videos, and campaigns. So this leads to a proper fair digital economy, and also brighter side, it leads to a proper sustainable future growth. Okay, all the Shah Rukh Khan fans in the room, can I hear some noise? Great. Now, this is not just a picture. It's a brand, it's a business, it's a digital empire in itself. 6 million likes, that is 60 lakh impressions. If each like adds something to the wallet, shouldn't it add and whisper something to the income tax department as well? Our current income tax framework does not provide these guidelines because it was only made for ledgers and paperwork. But with this growing culture of likes and reels, it should adapt to this as well, right? Okay. Now it's not about only money or dollars. It's about receiving handbags, skincare, and paid vacations. Picture this. This influencer got luxury handbags, and there is no involvement of cash in this at all. So the big question is this actually income? Absolutely yes. But if there is value in anything, it should be reported in the income tax side, whether there's involvement of money or not. These creators becoming full-fledged business. Now, let me ask you this. When was the last time you were scrolling Instagram Reels, watching someone post about their Dubai trip and finally getting a question, do these people actually pay taxes? Did you ever get this question? Yes or no? Yes. Arey wow, so much trust in your influencers. But let me tell you this. When these influencers are posting about their Dubai Reels, there is an income tax official secretly keeping a watch about what these influencers are not tracking. Let us look at this through an example. An influencer, a blogger in Bangalore. She used to randomly review cafes in Bangalore and brands reached out to her. Now she gets free meals, free kitchen appliances and also free vacations. Sounds great, right? But if the value of these kitchen appliances increased by 20,000 rupees, there would be a TDS on it at 10%. And also, if her income increases by 20 lakh rupees, she will have to be compulsorily registered under the GST Act. And also, starting April 2026, the digital platforms would have to be extra careful because the department has legal access to it. This meme pictures this confusion in a better manner. At the top, it is an influencer perfectly happy and thrilled about getting these luxury shoes. And at the bottom, it's an income tax official scratching his head, not knowing how to tag this, whether as business income, other income, or something entirely different. To conclude, I would like to say that when likes can earn lakhs, should the income tax department still hold on? Honestly, when content creation is king, shouldn't simplified tax rules also be catching up to this? Okay. I extend a heartfelt thanks to the Sikasa committee to conduct this beautiful presentation and having me as a part of this. And to the wonderful audience, thank you for your support, respect, and decision. Thank you so much.
That was a valuable perspective. Thank you, Honey. Our third presenter, Ms. Amulya P, is all set to deliver an engaging presentation on the paper titled, How Can Tax Systems Deal with the Cross-Border Influencer Income under DTAA? Amulya, a CA finalist, is currently pursuing her articleship at Ganesh and Sudhir Chartered Accountants in Udupi. Alongside her professional journey in finance and audit, Amulya has proudly represented her school, district and state in athletics, demonstrating her ability to excel both on the field and in the field of tax laws. With a strong passion for public speaking, Amulya aspires to use her voice to create a meaningful impact. Outside her academic and professional commitments, Amulya enjoys reading, exploring new series and maintaining a fitness routine. Let's give it up for Miss Amulya as she takes over the stage.
Thank you so much for this wonderful introduction. Hey guys, everyone here, let me introduce to my childhood bestie, Chutki. She was so famous back then and now she's a famous influencer. She's got over millions of followers in YouTube, Instagram. Her life was amazing with a growing fan base worldwide. Then she also she was getting her income from many diverse sources. Her life was amazing until the tax season arrived. One morning, Chutki calls me and she's like, bro, the US has withheld taxes from my YouTube earnings, and then even India wants to tax the same income under its global rules. And all flustered, she asks, why am I paying tax twice on the same money? So I say, ruko zara, sabar karo. We have DTAA to our rescue, Double Taxation Avoidance Agreement. So, as per Section 90 of Income Tax Act, DTAA is a treaty signed between countries to ensure that people like Chutki are not taxed twice on the same income. In this, the agreement, they allocate taxing rights. They reduce withholding taxes and provide methods for relief. And some countries, they agree upon a specific tax rate. so that the income earned in one country and the resident earned in different country will not be taxed or given, there will be no much burden. So when I said relief, there are two types of relief, that is bilateral and unilateral relief. Under bilateral relief, it is an agreement. It is a relief where there is agreement between two countries. First method is the exemption method. Under exemption method, only one country taxes the income. For example, if Chutki has an income in US and the US treaty says that that income will be taxed in only that country, then Chutki is not at all liable to pay taxes in India. Next, on the other hand, is the tax credit method. Under tax credit method, you are supposed to pay taxes in both the countries, but the resident country gives you a credit for whatever taxes you have paid abroad. For example, if Chutki has paid say 1 lakh in US and she is also liable to pay taxes in India amounting to rupees 2,50,000, then she gets a credit that makes her net tax payable 1,50,000. This is the case when there is an agreement. But have you wondered, what is the case scenario if there is no agreement between countries? That is when unilateral agreement comes into picture. According to section 91 of Income Tax Act, a resident who proves that he has an income that is arising or accruing outside India, and for that income he has paid taxes in that foreign country, a country with which there are no agreement, then he is entitled to a deduction. The deduction amount will be lower of average tax rate in India or average tax rate in the foreign country. So, just because I'm Papa ki pari doesn't mean I'm government ki pari. I'll not get relief just because I ask so. So there are some procedures that needs to be followed. Step 1 is determining eligibility. That is, you must ensure that there is a Indian resident who is having an income outside India, or there is a non-resident whose income is accruing in India. Because the source law says that when services are provided in India, though he is a non-resident, his income will be taxable in India. Next, as we saw earlier, we have two methods of relief if we have DTAA, that is exemption method and tax credit method. In India, generally we use the tax credit method. Next is the tax residency certificate. You need to provide a certificate, a proof that where you are residing, from which country you belong. And for Indian residents, if you want a tax residency certificate, then you apply in Form 10FA, then you get your TRC in Form 10FB. Next is furnishing Form 10F. This form is only applicable if there are not all the necessary information contained in your tax residency certificate. For example, nationality, tax identification number, tax residency and relevant DTAA articles. Next, this form is mandatory to be filed. You have to know this form if you want to claim your foreign taxes paid. This is Form 67. The documents required for filing this form is your foreign taxes paid, copy of foreign tax returns and your TRC. All these documents are required. And before you file ITR, you are supposed to file this Form 67. Next, you have to claim your relief under the applicable ITR form. Under Schedule FSI and Schedule TR, that is foreign source income or tax relief, you need to enter the details such as country name, nature of income, amount of tax paid in the foreign. Such details need to be included. So from that time I was blabbering ITR this, ITR that, form this, form that. But which ITR are you supposed to file? ITR 2. In case you have a foreign income other than business. For example, royalty or commission. But make sure the royalty should not be part of your business income. ITR 3, if your income is from businesses, so for example, ad revenue, brand collaboration, sponsorship, affiliate marketing, all these contribute to business income. For that, you will be filing ITR 3. Now, when I was talking about all these procedures, even Chutki started getting distracted just like that guy sitting with black shirt. So, what I did was, like any other Desi auntie, I want to complain something about this. First one is the compliance burden. Here, when I was talking about the procedure, I said we need documentation, we need to file form 10F, we need to file this ITR, we need to file form this, you need to have all the details for which you have provided services. This can be burdensome for some people if they don't have a proper professional guidance. Next is unclear income classification. Here, some might say this is income from other sources, some might say it is income from PGBP. There can be confusion about treating what is the source of income. This leads to tax confusions. Next is lack of DTA with certain countries. So, we don't have agreement with all the countries. Here, when there is no agreement, what we saw earlier, that we have unilateral relief, but that relief is less favorable. Because whatever taxes you have paid abroad, that whole sum might not be covered, which increases your tax burden. Next is the different tax years and currency conversion. How we are filing tax, the reporting period in other countries might differ. This timeline issues can happen, and exchange rates always fluctuating. You're always on the market looking at what is the rate, what is that. So, what we do here, the current exchange rate used by the influencer can be totally different what is actually prescribed. This confusion can lead to over or under reporting of the income, which is not at all preferable. So, as I want to conclude, success is not just about going viral. It's about knowing where your income is earned. You have to know how you're being taxed, where you're being taxed. And you should also know your rights and protect your earnings legally. When I was telling about all these challenges, you can smoothen this up with proper filing, with proper documentation. Today Chutki is smarter because she has a professional like me to help her. But you should also seek guidance. With all this, behind every great reel and a viral tweet, it is always a TRC and a spreadsheet that helps you. So, to all the creators out there, don't let tax be your blind spot. Thank you for your patience learning. Thank you, moderator, and thank you for all the co-presenters present here. Thank you.
Last but certainly not the least, we have Ms. Shaik Amina Zaakira, who will present an insightful paper titled When Your Feed Becomes Your File. Is social media the new Form 26 AS? Hailing from Uppala, Kasargod, Shaik Amina Zaakira is gaining valuable experience during her articleship at Rao and Basri under the guidance of CA Chandrakant Rao. She has earlier presented her paper at the CA Students National Conference 2024-25 in Mangaluru on the topic Space Economy. She has won several accolades in inter-school competitions for art and craft as well as group singing, demonstrating creativity and team spirit alongside academic focus. Let's give a big round of applause to Zaakira as she takes the stage to share her insights with us.
So, very good morning everyone. I am Zaakira. So, the topic which I am going to present today asks a question that whether the social media is a new Form 26 AS. To understand this, let us start from the very beginning. You tell me what tells us more truth. Is it a person's Instagram or is it his ITR return? Come on. Okay, so in the current scenario where people almost post everything what they post all those luxurious consumptions, they do all those fancy dinners, foreign vacations, asset acquisition, luxury car purchases, they are hardly paying any taxes. They are hardly showing any income their ITR returns. Why is it so? So see, we live in a country like India where the total population is 140 crores and last year only 8 crore of people have filed their ITR, which is only 6.7% of the total population. So the obvious question is whether the rest are not earning or whether they are not declaring. See, it is obviously impossible for the government to go and knock on every single door, but the government can scroll through your social media. The next, so it is not the first time that the government is trying to tax you through your lifestyle. See, in today's, we live in a country where the total population is 140 crore, but the ITR file is 8 crore. Just imagine, that is a huge gap. The government definitely not going to ignore that. So what does the government do? The government starts mining your data. And in today's era, such data mining is not just limited to your bank statement or your TDS slips. It goes beyond that. The government starts data mining with your lifestyle. So this is not the first time where the government has tried to tax you based on your lifestyle. It has happened before. So let's go back to history. That is in 1958, the government introduced the Expenditure Tax Act 1957. The intention of the government behind this was that if you don't show me your income, I'm going to tax you through your expenses. So the people's expenses were getting taxed. But in 1962, due to a lot of administrative complexity, it was repealed. But again, the government tried to reintroduce in 87. But again, it was limited to hotel expenses, restaurant expenses. And again, due to complexity, it was abolished. See, back in the time, the government didn't have much resources. But today, the government has data, and the data is the new auditor. So you can see how the government slowly started collecting your data. First, it was through your cashless economy. So government started tracing your expenses and income. Have you heard that recently one of the Pani Puri vendor had got income tax notice because he was earning 40 lakh a year to the UPI transaction? How did government got to know this? Through the data. Similarly, the government started monitoring your social media as well. The government is noticing the brand collapse you're using. The government is noticing all the luxury lifestyles as you're having, and the government is using AI to detect those. So see, it is not a difficult task for the AI to see the mismatch between your social media and your lifestyle. In the future, the government may also incorporate smart tools like facial recognition, etc., etc. So I'll tell you a recent case. What happened was that there was an influencer who had around 85,000 followers in the Instagram. And she got an income tax notice. Why? Because she was going on luxury vacations. She was getting this big brand collaboration. And just imagine, she only declared 3.2 lakh of income in her ITR. You're going to think that the department going to ignore this? Definitely not. Her Instagram triggered a digital tax audit. So now whatever I'm telling is just not in the air. It is the actual law now. So in the recent budget, that is budget 2025, it says that from 1st of April 2026, that is the financial year 2027, the authorities will have the right to access your social media, your cloud storage, your net banking and everything. Not only this, but they can even override your passwords. So the specific, the Direct Tax Bill 2025 talks about 3 specific sections which include social media audit. The first one was section 132. So section 132 was already there, so it is not something new, but it has been restated by the department. So as per section 132, it gave the authority the rights to seize your electronic records. But now in the current bill, it includes that the authority can also seize your virtual digital space. Now, what is virtual digital space? So the authority has the right to seize your virtual digital space. Now, what is virtual digital space? The virtual digital space is your Instagram, your net banking, your trading account, everything. Next, the next section is section 247. So this was a new section which was introduced in the direct tax bill, which tells that the authority can override the password. Like they can break into your social media if they really have to do so. The next section is section 253, which says that the authorities can even access your social media during survey visit. But whenever such new bill comes, there are always some concerns regarding this. There are three major concerns for this particular bill. First one is, can a styled photo be used as a financial evidence? So just imagine, like we know many people just rent few assets just for the sake of one social media post. Now the government cannot tell the difference between the actual asset and the rented asset. Also, if the government uses AI for this particular purpose, the AI cannot tell the difference between owned car or a rented car. The AI might misinterpret the data. These were the two major concerns, but one of the important concern is privacy. So is data mining public feeds really ethical as per the privacy concerns of a person? We can understand this with the help of a landmark case, that is Justice K.S. Puttaswamy versus Union of India. So in 2012, K.S. Puttaswamy, who is a retired judge, argued that the Aadhaar card is violating a person's privacy by requiring him to share sensitive information like his biometric data, etc. So in this particular case, the Supreme Court gave the judgment that every person has right to privacy under Article 21 of the Constitution. Such digital intrusion of the data should only be done under if the three tests has been passed by it. The first one is legality. If such digital intrusion should be backed by a proper law. Second is necessity. There should be an absolute necessity to do so. Third one is proportionality. That means it should be the least intrusion option, which means that if really such digital intrusion is required, it should be done in such a manner that it causes least harm to a person's privacy. So as we can see, in the context of this, the new direct tax bill satisfies only one condition, that is legality, that it is properly backed by a law. But regarding rest, that is necessity and proportionality, the question is still vague about it. The new direct tax bill talks more about social media audit and stuff rather than not like the other old one. So coming back to the question that whether the social media is the new Form 26 AS, I would say not yet, but it is slowly becoming your digital identity. See, we live in a country where the total population is 140 crore and only 8 crore people are filing their ITR. But more than 80 crore people have access to internet, and every feed tells us a story. So coming to the question that whether the Form 26 AS is actually gonna, whether the social media is actually Form 26 AS, well, definitely not yet right now. But talking about future tax compliance, it is not in the paper anymore, it is in your screen and it is watching you. So lastly, I want to conclude saying that your feed is now public and your files must watch that. Thank you.
Thank you, Zaakira, for helping us enrich our understanding. We have now come to the end of our paper presentation segment. Please give a big round of applause to all our presenters. Each presentation reflected passion, dedication, and a strong command over the subject matter. We truly commend the efforts of all our participants. Constructive feedback transforms good work into an exceptional impact. It's now my honor to invite person, CA Malavika Kamath, to offer her reflections and guidance on today's presentations.
Hello, audible? To the audience as well? Okay. First of all, congratulations to each of you. It's a girl power here today. All the four of you have really went into the topic as vague as it is. The topic is so vast, you could make anything out of it. And you prepared well and you have presented in the time given. Most of you have even, adhered to the time that is given, which is really difficult considering the topic that is, you can talk for hours together. I mean, some of you spoke so much that I could keep listening to you. So it was really good. I would like to congratulate each one of you for that. Especially Honey, even when the TV went off, you didn't lose your calm. You kept it. So that's a good job there. And even you, in the last, when your TV went off, you asked for help. So that's really good. I just had to add a few pointers, which I regard, it's technical regarding the topic. So just to give a background of this, in the year 2015, some G20 countries got together and they realized that the existing tax system does not address everything that there is regarding the economy, that digital economy especially. The tax system that there is more than 100 years old, but the existing economy is developing in such a rapid pace, it's not able to, cover everything that there is. So they decided they have to do something about it. OECD, you all may have heard about this. So they were already working on a project such as this to give more clarity on taxation internationally. So G20 nation welcomed it. There was 15 action points that OECD, BEPS action plans it's called, base erosion and profit shifting. So 15 action points were declared or announced rather. So the action point number 1 speaks about addressing challenges in taxation of digital economy. So here they went, it's a 300-page document which was released in 2015. Since then to now, there has been more changes in social media, but in that year when they have discussed and deliberated and come up with the document, there they have come up with some ideas as how we can tax it, what are the normal challenges there are. And there was something called a significant economic presence, which was coined by these action points, which India has adopted in Section 9 of the Income Tax Act, where a corporation, any person can be taxed based on their virtual presence. It's something that is groundbreaking because as tax professionals, we know where there is business connection or physical presence, only then you can tax it. But virtual PE is a concept that exists in the Indian Income Tax Act, even in the 1961 Act. And it's based on engagement, based on interaction, based on customer engagement. I am not sure how they track the engagement, but this significant economic presence continues to exist in the new income tax bill as well. So which India has been a pioneer in taxing the digital economy. It has no way out because around 31 lakh crores is the amount that contributes to the total economy from digital economy, which comes to around 12% of the total GDP comes from digital economy. So you can imagine 12%, it's going to be 20% in 2030. So by 2030, digital economy is going to surpass manufacturing sector and even service sector. And my friends here are going to be young professionals who are going to throw more light into how to tax digital economy. We need more and more professionals like here, my friends and you all, who need to look into this aspect, and all of us who are already into practice have to keep our eyes upon this particular field which is evolving like never before. And I would like to thank everyone. You have been a very patient, wonderful audience. And I would like to thank the management committee and the SICASA committee for organizing such a wonderful event. Every year you just surpass the last year's conference. I'm just amazed. Like at this point I can say I'm not amazed. It's really great the work that you put into a conference and the outcome it has. yet another successful conference. Congratulations to you all, and thank you for having me here. It's really great to be a part of this conference. Thank you.
Thank you, ma'am, for your words of wisdom. As we draw this informative session to a close, I extend my heartfelt thanks to CA Malavika Kamath for chairing this session and giving your valuable feedback to us. To all the presenters, your ideas and insights have indeed added great value to this event. I now request CA Chandrakant Rao to hand over the token of gratitude to our dear chairperson and the paper presenters. Thank you, sir.